Negotiable instruments are the backbone of our financial system. Every time you write a check, sign a promissory note for a mortgage, or endorse a payment, you're participating in a system governed by a specific set of rules. These rules, found in Article 3 of the Uniform Commercial Code, ensure that financial promises can be safely transferred between parties. UCC Article 3 establishes the framework for negotiable instruments, specialized financial documents that can be transferred from person to person while maintaining their value and enforceability. Without these rules, our modern economy would struggle to function efficiently. What makes a document a negotiable instrument under UCC 3? 4 essential criteria must be met. First, it must be in writing and signed by the maker or drawer. Second, it must contain an unconditional promise to pay a fixed amount of money. Third, it must be payable either on demand or at a definite time. And fourth, it must be payable to order or to bearer, with an exception for checks. When these instruments change hands, they can be endorsed in several ways. A blank endorsement consists of just a signature, making the instrument payable to whoever holds it. A special endorsement names a specific person to whom the instrument is payable. Restrictive endorsements limit how the instrument may be used, such as writing for deposit only. And qualified endorsements, like writing without recourse, disclaim liability if payment is dishonored. One of the most powerful concepts in UCC 3 is the holder in due course. This status gives significant protections to someone who acquires a negotiable instrument in good faith, for value, and without notice of any problems. A holder in due course can enforce payment, even when previous parties had valid defenses against paying. This special status promotes the free transferability of negotiable instruments in commerce. Recent amendments to UCC 3 have addressed several practical issues. One important change clarifies that someone who loses possession of a negotiable instrument can still enforce it under certain conditions. This helps financial institutions maintain enforcement rights even after inadvertent loss of documents, which is particularly important in transactions involving pooled instruments. Another amendment protects borrowers from potential double liability when loans are transferred. Under UCC Section 3602, if you make a payment to your original lender before being properly notified of a transfer, you cannot be forced to pay again to the new holder. This creates a fair balance between the interests of borrowers and the financial institutions that buy and sell loans. The rules also address modern banking innovations like remotely created checks, which are authorized by consumers over the phone. Transfer warranties ensure that the bank or customer transferring such a check affirms that it is authorized for the amount shown. This protects the payment system from fraud while allowing convenient payment methods. Surety rules have been updated to align with modern commercial practices. These rules protect endorsers and accommodation parties from improper discharge while maintaining their recourse rights. When someone signs a negotiable instrument to guarantee payment by another party, these rules determine when their obligations might be discharged and what impact that has on other parties. Banks also have specific responsibilities under UCC 3. When presenting checks for payment, banks make warranties that they are entitled to enforce the check, that it has not been altered, and that signatures are authentic. These presentment warranties protect the integrity of the check clearing system and promote trust in financial transactions. The framework established by UCC Article 3 ensures that negotiable instruments remain reliable tools for commerce. By clearly defining the rights and obligations of all parties involved, these rules create the certainty needed for efficient financial transactions. Whether you're writing a check, taking out a loan, or transferring payment rights, UCC 3 provides the legal foundation that makes these everyday financial activities possible and secure.